You must avoid this mistake because after 50, one dumb decision can be arithmetically lethal. I once said I could have been twice as rich if I hadn't made one mistake 50 years ago. That's the power of compounding working against your stupidity. Here's the unpleasant truth. By the time you reach 50, your ability to take wild risks is gone, unless you enjoy gambling your retirement, which is as wise as betting your house at a casino. The world loves talking about finding the next Tesla, but at this stage, survival is the only real game. I watched people during the Great Depression lose everything, not because they weren't smart, but because they borrowed too much. The pattern repeats every generation. The faces change, the stupidity doesn't. My number one investment tip for those over 50 is simple. Play defense, not offense. Your offensive years were your 20s and 30s. Now, the clock isn't your friend. If you lose half your money at 60, you may not live another 30 years to recover. You have to shift from trying to be clever to trying not to be stupid. That means you must avoid leverage. Debt is absolute poison when you don't have decades to repay it. It guarantees that when bad times come, you're the first to get wiped out. Forget chasing unicorns. The smartest guy in the room is usually broke. Your goal now is durability and staying power. You need to know what will wipe you out, and then don't go there. Don't let your ego talk you into a financial catastrophe. What is the riskiest investment you currently own, and why haven't you sold it? Drop a comment below. Remember, think about your next move. The biggest killer of portfolios after 50 isn't a recession, it's envy. People go broke because they can't stand watching someone else earn more. They see a friend brag about a 10-bagger stock, and suddenly their stable compounding investment looks like a mistake. I've called envy the dumbest of the 7 deadly sins, and I meant it because you get no pleasure from it, only resentment that pushes you into ruin. The solution is to stop measuring your life against your neighbor's portfolio. In the 1990s, Warren and I owned boring businesses like candy and insurance. We looked stupid until the bubble burst in 2000. The same people who laughed at our slow investments were suddenly broke. We were still rich. The game isn't about beating others, it's about not losing yourself. At 50 or older, envy is lethal because you don't have time to rebuild from an envious, stupid move. The best investors have almost zero concern for what others are doing. They care about staying solvent and compounding quietly. So, if you're over 50, here is your piece of advice. Stop caring what anyone else earns. Stop scrolling through financial gossip. Envy won't make you richer, but it will push you into the speculative bets that erase decades of patience. Your retirement doesn't care if someone else made more. Only your ego cares, and your ego has bankrupted more investors than any bear market ever did. The market rewards the patient, not the excitable. You don't need to be spectacular, you just need to be solvent. Don't aim to get rich quick, aim not to die poor. And remember, think about your next move. If you want the one blunt truth that summarizes this entire strategy, listen to this.
I could have been twice as rich if I hadn't made one dumb mistake 50 years ago. That's not me being dramatic, it's just arithmetic. Compounding works both ways on your gains and on your stupidity. Now, let me tell you something unpleasant. By the time you're 50, most of your big moves in life are already behind you. Your career trajectory is set. Your family situation is what it is. And your ability to take wild risks, gone. Unless you enjoy gambling with your retirement, which is about as wise as betting your house at a casino. The truth is simple. After 50, you don't need brilliance. You need to avoid disaster. People love talking about finding the next Tesla or striking gold in crypto. That's just noise. At 50, survival is the real game. I grew up in the Great Depression. I watched people lose everything, not because they weren't smart, but because they borrowed too much, trusted the wrong crowd, or thought good times would last forever. The pattern repeats every generation. The faces change, the stupidity doesn't. Here's my number one investment tip for those over 50. Play defense, not offense. You already had your offensive years, your 20s, 30s, maybe 40s. That's when risk-taking could pay off because you had time to recover. At 50, the clock isn't your friend anymore. Most people don't understand this. They hit midlife and think they're supposed to catch up. They pile into some hot stock or a get-rich-quick scheme. What happens? They go broke faster than they can say retirement plan. Let me illustrate. I once knew a man, very bright, Ivy League education, well-off career. At 55, he decided he was behind his peers. He dumped a fortune into dot-com startups in the late 1990s. By 2002, he had less than half left. He spent the rest of his life talking about what he almost had. A waste of brains and money. The irony? If he'd just parked his money in boring, reliable businesses, Coca-Cola, Procter & Gamble, Johnson & Johnson, he would have been fine. Not glamorous, not exciting, but fine. Sometimes fine is all you need. People over 50 often forget that the real enemy isn't underperformance, it's catastrophe. Losing half your money at 60 is not the same as losing half your money at 30. At 30, you still have 30 more years to recover. At 60, you may not even live another 30 years. It's not a cheerful thought, but it's reality. You have to shift from trying to be clever to trying not to be stupid. And believe me, avoiding stupidity is a full-time job. So, if you're over 50, forget chasing unicorns. Forget trying to be the smartest guy in the room. The smartest guy in the room is usually broke, divorced, or both. Your goal now is durability, staying power, having enough money to outlive your mistakes. I often say all I want to know is where I'm going to die, so I'll never go there. For investing after 50, all you need to know is what will wipe you out, and then don't go there. That means avoid leverage. Debt is poison, especially when you don't have decades to repay it. Avoid speculation. You're not going to outtrade the 25-year-old with 6 screens and no life. Avoid complexity. The more complicated the deal, the higher the odds you're the patsy. At 50, your best strategy is to keep things boring. Boring works, boring compounds. Boring lets you sleep at night. The financial world doesn't reward excitement, it punishes it. So here's the paradox. The less thrilling your investments are after 50, the more likely you'll enjoy a thrilling retirement. Don't aim to get rich quick. Aim not to die poor. Envy has ruined more portfolios than recessions ever did. People don't go broke because they can't earn. They go broke because they can't stand watching someone else earn more. I've called envy the dumbest of the 7 deadly sins, and I meant it. Why? Because it's the only one where you get no fun at all. Greed, you get to enjoy spending. Gluttony, you get to eat. Lust, you get some pleasure at least. But envy, you just sit there stewing in resentment while the other guy is off enjoying his yacht. It's also contagious. If your neighbor buys a fancy car, suddenly you think you need one. If your brother-in-law brags about a 10-bagger stock, suddenly your stable compounding investment looks like a mistake. That's when trouble begins. Let me give you an example. In the 1990s, Warren and I owned boring businesses. Insurance, candy, furniture stores, newspapers. Nothing flashy. Meanwhile, Silicon Valley kids half our age were making billions out of thin air. We looked stupid until the bubble burst in 2000. The same people who laughed at our slow investments were suddenly broke. We were still rich. Here's the lesson. The game isn't about beating others. It's about not losing yourself. Envy makes you forget that. I once knew a man who invested reasonably well. Steady returns, decent savings, but then his golf buddies got rich in oil stocks. He couldn't stand being the small timer. He levered up, chased the same trades, and when oil collapsed, so did his portfolio. His buddies lost money too, but they still had their careers. He had retirement to worry about. At 50 or older, envy is lethal. You don't have time to rebuild from your own stupidity. One envious move can erase decades of patience. The best investors I've known had almost zero concern for what others were doing. They didn't care if their neighbor bragged about a hot stock. They didn't care if CNBC shouted about the next big thing. They cared about staying solvent and compounding quietly. The irony is, if you want a happy old age, you should root for your friends to succeed. Envy makes you miserable when others do well. That's a terrible way to live. Imagine being 80 years old and still bitter that someone else had a bigger house. What a waste of a life. I've outlived plenty of people richer than me at one point, but I never envied them. I knew most of them were playing games they couldn't win long term. Sure enough, they burned out, or their money evaporated, or they drank themselves to death. Meanwhile, I stayed boring, rational, and alive. So if you're over 50, here's a piece of advice you can take to the bank. Stop caring what anyone else earns. Stop measuring your life against your neighbor's portfolio. Stop scrolling through financial gossip as if it matters. Envy won't make you richer, it won't make you smarter, it won't even motivate you. It'll just push you into stupid decisions. And remember, your retirement doesn't care if someone else made more. Your family doesn't care. The grocery store doesn't care. Only your ego cares. And your ego has bankrupted more investors than any bear market ever did. So envy is not just a sin, it's a bad investment strategy. Don't play it. I don't like talking about my mistakes, but they're more useful to you than my successes. Everyone loves to hear about the winners. Few stop to examine the losers. That's where the lessons are buried. Here's one of mine. Decades ago, I bought into a company without truly understanding its future. On paper, it looked cheap. The numbers were clean. Management seemed competent. But I didn't think deeply enough about the business model. The result, I made a quick profit, but I sold too soon. If I'd had the patience and the insight to hold, the position could have doubled my net worth. That's not hyperbole. It's math. Compounding doesn't forgive early exits. The mistake wasn't the investment, it was me. I lacked discipline in sticking with a truly great business. I settled for being right in the short term instead of being rich in the long term. Most investors do the same. They sell winners too soon, and they cling to losers too long. It's backward. You should do the opposite. But it's hard. Human nature pulls you the wrong way. People love certainty. When something goes up, they want to lock in gains. It feels safe. But selling Coca-Cola after a modest rise in the 1970s was not safe. It was foolish. That stock kept compounding for decades. Anyone who sold early was congratulating themselves while quietly robbing their future self. I don't beat myself up about it anymore. Regret is wasted energy. But I do use the memory to remind myself of one simple rule. If you find a truly great business, sit on your ass and hold it. Don't get clever. Don't get itchy fingers. The world constantly tempts you to do something. Turn on the news and you'll see endless reasons to act. Elections, wars, inflation, recessions. But most of that is noise. Good businesses survive. Great businesses thrive. Your job is not to outguess every headline, it's to avoid selling the goose that lays golden eggs. Now for people over 50, this lesson matters even more. You don't have the luxury of making a mistake and waiting 40 years for compounding to bail you out. One wrong exit, one badly timed, clever move can shrink your nest egg permanently. I see it all the time. Someone holds a reliable dividend-paying stock for decades. Then they read a newsletter about some disruptor and decide to rotate out. They dump Johnson & Johnson and chase a tech IPO. A few years later, they're wondering why their income dried up and their account is bleeding. The mistake isn't failing to predict the future. Nobody can. The mistake is abandoning what works in pursuit of what excites you. Excitement is a terrible investment strategy. I could have been richer if I had learned this earlier, but at least I learned it. Many never do. They spend their entire lives hopping from one opportunity to the next, while the boring investor next door quietly builds real wealth. So here's the takeaway. It's not brilliance that makes you rich, it's endurance. It's the ability to hold on when everything tempts you to let go. If you're over 50, you can't afford to repeat my mistake. When you find a business that will still be making money 20 years from now, hold it, sit still. Don't sabotage yourself by being clever. In the end, the market rewards the patient, not the excitable. Remember, I became wealthy by being consistently not stupid, not by chasing brilliance. The older I get, the more I realize this. Most people are far too sure of themselves. And the market punishes that kind of arrogance sooner or later. I've watched it for nearly a century. In the 1930s, people were certain prosperity would never return. They hoarded cash and missed the rebound. In the 1960s, everyone was sure America's big companies would always compound at high rates. They ignored valuations and got crushed in the 1970s. In the 2000s, investors thought tech stocks would only go up. We all know how that ended. Confidence feels good, but it's not correlated with accuracy. In fact, I've seen the opposite. The people who sounded the most certain were usually the ones who lost the most money. Here's the reality. The world is too complex for you to know everything. You don't get rich by being a know-it-all. You get rich by knowing what you don't know and avoiding it. When Warren and I built Berkshire, we passed on thousands of opportunities. We didn't understand them, so we ignored them. And guess what? We didn't miss much. The world throws plenty of pitches. You don't have to swing at every one. But most investors can't resist. They think having an opinion on everything makes them smart. They'll tell you where oil is going, what interest rates will be next year, and how some new startup will revolutionize everything. What they don't tell you is that 90% of those opinions will be wrong. At over 50, this flaw becomes more dangerous. You don't have the same margin for error as a young gambler. If you throw money behind your half-baked opinion, the market won't forgive you. And unlike at 30, you don't get another 30 years to rebuild. I once watched a successful lawyer in Los Angeles, sharp guy, good income, decide he was also an expert on currencies. He read a few articles, formed an opinion, and bet heavily against the yen. It wiped out most of his retirement savings. Not because the yen was unpredictable, that's obvious, but because he was too confident in his ability to predict it. The irony? If he'd admitted, "I don't know," and left his money in something boring, he would have been fine. But people would rather be wrong loudly than silent wisely. Here's what I recommend. Develop the courage to say, "I don't know." It's a rare and valuable trait. If you can admit ignorance, you won't bet on nonsense. You'll stick to areas where you actually have competence. That's what we did at Berkshire. We understood insurance. We understood Coca-Cola. We understood See's Candies. So we bought them. We didn't understand airlines or .com stocks, so we left them alone. That one habit saved us from disaster more times than I can count. Overconfidence kills more investors than recessions. It's not the market that ruins you, it's your illusion of knowing more than you do. So, if you're over 50, listen carefully, stop acting like an oracle. You don't need opinions about every sector, every trend, every country. You only need to know a few things well and admit you know nothing about the rest. In fact, I'd go further. The more certain someone sounds about the future, the faster you should run. Remember, the world is full of people eager to sell you certainty. Analysts, pundits, salesmen, they all sound smart. But none of them will pay your bills when their certainty blows up your portfolio. So the next time you feel the itch to predict the unpredictable, stop and ask, what if I just don't know? That question may save your retirement. One of the biggest divides I've seen in life is between people who think like employees and people who think like owners. It has nothing to do with job titles or paychecks. It's about mindset. Most people, even very smart ones, spend their lives playing career games. They optimize for promotions, titles, and perks. They spend years currying favor with bosses they don't respect. They polish resume instead of building wealth. That's careerism, and it's a trap. I've said many times, the world is not driven by greed, it's driven by envy. Careerism feeds on that. You watch the guy next to you get a fancier title and suddenly you want one too. But title don't compound. Ownership does. When Warren and I built Berkshire, we didn't care about looking important. We cared about owning things that made money while we slept. See's Candies, Coca-Cola, insurance companies, they didn't care whether we were vice president of this or senior partner of that. They just sent us checks. Meanwhile, I watched brilliant lawyers, bankers, and executives waste decades climbing ladders. They earned high incomes but owned nothing that worked for them. The minute they stopped showing up, the money stopped too. That's not wealth. That's just a high-class treadmill. Let me give you an example. Back in my law days, I worked alongside some of the sharpest minds you could imagine. They billed clients by the hour, made a fortune, and thought they were kings. But if they dropped dead, their income dropped dead too. They owned nothing scalable, nothing durable. They were rich employees, not owners. By contrast, Warren and I channeled our time into building ownership. We wanted businesses that didn't depend on our presence every day. That way, even if we were golfing or dead, the assets kept compounding. That's the difference. If you're over 50, this lesson matters more than ever. You don't have time to keep trading your hours for dollars. Eventually, your energy runs out. Your health falters. The treadmill stops. So ask yourself, do you own anything that works for you when you're not working? Real estate that pays rent, stocks that pay dividends, a business stake that keeps earning whether you show up or not. If the answer is no, then you're not really investing, you're just extending your career under another name. Careerism also clouds judgment. Employees think about pleasing bosses. Owners think about surviving reality. That's a massive difference. A careerist lawyer will do whatever makes a partner happy. An owner asks, does this make money long term? Only one of those questions compounds. I'll tell you something harsh. If you're over 50 and still living paycheck to paycheck, no matter how high that paycheck, you've probably been thinking like a careerist too long. You've optimized for the wrong game. The good news, you can still shift. Stop caring about titles. Stop caring about what colleagues think. Care about ownership. That doesn't mean quitting your job tomorrow. It means redirecting your energy and capital into assets that outlast you. Buy boring, durable businesses. Live below your means. Build ownership stakes instead of wasting money trying to look successful. It's a quieter game. Nobody claps for you when you buy shares of Procter & Gamble. But in 20 years, those shares will be paying you when the applause has long faded. Careerism fades. Ownership compounds. Pick the one that will still matter when you're 70. If you live through the Great Depression, you never really forget it. I was born in 1924. By the time I was a boy, the economy had collapsed. Banks failed. Businesses folded. Families went hungry. People today think volatility is when the stock market drops 10%. In 1932, the market had fallen almost 90% from its peak. That wasn't volatility. That was financial annihilation. I watched grown men lose their livelihoods. I saw families move in together because they couldn't afford rent. My own family knew what it meant to cut corners and stretch every dollar. It was grim, and it left a permanent mark on how I see risk. The biggest lesson, you can't count on good times to last forever. People today forget that. They think prosperity is the default setting. It isn't. Civilizations rise and fall. Economies swing between feast and famine. If you live long enough, you'll see both. The Depression taught me to respect reality. Optimism is fine, but blind optimism kills. Plenty of people in the 1920s thought the good times would never end. They borrowed money, speculated wildly, and leveraged themselves into oblivion. When the crash came, debt destroyed them. That's why I've always despised debt. It makes you fragile. With no debt, you can survive bad times. With debt, bad times kill you. Another lesson, resilience beat brilliance. I saw small, boring businesses survive the Depression by being frugal and adaptable. Meanwhile, fancy operators with clever schemes vanished overnight. The survivors weren't geniuses, they were simply durable. That's a lesson most investors still don't get. Everyone wants to be clever. Nobody wants to be durable. Yet durability is what gets you through a once-in-a-lifetime collapse. I carried those lessons into my investing career. I don't try to predict recessions, nobody can. What I do is assume they'll come eventually and prepare accordingly. That means keeping a margin of safety. That means avoiding leverage. That means owning businesses that sell products people will keep buying in good times and bad, like candy, soda, insurance. People mocked us for buying See's candies. How much money can you make selling chocolates? They laughed. Well, it turns out people eat chocolate in recessions too. They eat more of it, in fact. See's survived downturns that crushed flashier businesses. That's the kind of lesson you learn only after seeing true hardship. Now, if you're over 50, you need to remember this above all. You don't get a second Great Depression to relearn the lesson. If you blow up your finances once, you won't live long enough to rebuild. That's why you must structure your portfolio for resilience, not fantasy. When you hear people brag about how much leverage they're using or how brilliant their trading strategy is, remember 1932. Remember breadlines. Remember men who thought they were smart, suddenly standing in soup kitchens. The world has changed since then, but human nature hasn't. People still get greedy, still take on too much debt, still assume good times will roll forever. And every few decades, reality slaps them in the face. So my advice is simple. Learn from history you didn't live through. You don't need another Great Depression to understand the danger of stupidity. All you need is humility and memory. If I had to reduce my so-called success to 3 habits, it would be this. I avoided debt, I avoided drama, and I avoided dumb people. That's it. No magic formulas, no secret sauce, just subtraction. Let's start with debt. I've said it before, Debt is poison. It destroys discipline. It magnifies stupidity. And it guarantees that when bad times come, and they always come, you're the first to get wiped out. I watched people in the 1930s borrow against their homes, thinking they were safe. When the crash came, they lost everything. That image stuck with me. Warren and I built Berkshire without leaning on borrowed money. We could have juiced returns with leverage, sure, but one or two wrong bets with debt, and we'd be broke like everyone else. Staying solvent was more important than looking clever. If you're over 50, debt is lethal. At 30, maybe you recover. At 60, it's game over. You won't live long enough for compounding to save you. Now, drama. I don't tolerate it. I avoided unnecessary fights, pointless feuds, and people who seemed addicted to chaos. Drama wastes energy. Energy that could be spent thinking clearly, building patiently, or enjoying life. Plenty of smart men have been ruined, not by bad investments, but by bad divorces, bad partnerships, or bad temper. You can be brilliant in finance and still bankrupt yourself with personal chaos. I wasn't interested. Then there's dumb people. And by dumb, I don't just mean low IQ. I mean people who are reckless, dishonest, unreliable, or addicted to shortcuts. They're radioactive, their stupidity spreads. Hang around them long enough and you'll get caught in the fallout. Early in my career, I saw colleagues fall in with slick operators who promised big returns. The pattern was always the same: fast talk, shady deals, inevitable collapse. The smart colleagues ended up dragged down simply by association. I made it a rule: better to have fewer friends and partners, but high-quality ones. My partnership with Warren worked for 50 years, not because we never disagreed, but because we shared the same principles: rationality, patience, honesty, no drama, no debt, no stupidity. That made us durable. Most people underestimate how much avoiding the wrong things matters. Everyone looks for the right stock, the right deal, the right opportunity. They ignore the fact that saying no is more important than saying yes. One yes can make you money. One wrong yes can ruin you forever. If you're over 50, this is not optional. You can't afford to waste years untangling from bad decisions. The margin for error is gone. So cut ruthlessly. No debt, no drama. No dumb people. It sounds harsh, but it buys peace of mind. And peace of mind is worth more than squeezing out a few extra percentage points of return. Remember, wealth is not built by brilliance, it's preserved by discipline. And most discipline is just the ability to walk away from stupid temptations. People love to romanticize my partnership with Warren. They think we sat in some ivory tower playing chess with billions of dollars, always in agreement, always brilliant. That's nonsense. What actually worked wasn't magic. It was discipline, temperament, and compatibility. And what didn't work? Well, let's just say we made our share of blunders, though fewer than most. Here's what worked first. We trusted each other completely. No backstabbing, no politics, no jealousy. That's rare in business. I didn't wake up worrying Warren was scheming against me, and he knew the same about me. That trust gave us enormous efficiency. Most organizations waste half their energy on internal nonsense. We didn't. We also thought the same way about money. We both valued patience, rationality, and independence. Neither of us cared about looking fashionable or chasing Wall Street's approval. If something didn't make sense, we didn't touch it no matter how many people mocked us. Another thing that worked: complementary skills. Warren was a genius at spotting undervalued businesses. I was better at reminding him not to get seduced by cigar butts, those crummy little companies you buy cheap and sell for a small profit. Together, we aimed higher. We bought quality businesses at fair prices and held them. That shift was worth billions. Now, what didn't work? Well, for one, we weren't perfect judges of people. We occasionally backed managers who turned out to be crooks, fools, or both. You can't screen for every human weakness, but it annoyed us. Character matters, and when we got it wrong, it cost us. We also underestimated how hard it is to change human behavior. Some companies looked fixable on paper. Better management, better incentives, maybe a turnaround. But you don't change corporate culture easily. If the DNA is rotten, new wallpaper won't help. We learned that the hard way. And yes, we missed opportunities. People think Berkshire grabbed everything good. Wrong. We passed on things that, in hindsight, would have been spectacular. tech companies, for instance. Warren admitted he didn't understand them well enough. Neither did I. In that sense, our caution cost us upside. But I'll tell you what, I'd rather miss upside than blow up chasing what I don't understand. That caution may have cost us billions, but it saved us from disasters that would have cost more. Our biggest strength was knowing the limits of our knowledge. Most investors don't have that. They want to be experts on everything. We didn't. We stuck to our circle of competence. If it was outside, we just said no. That simple habit explains most of Berkshire's durability. If you're over 50, you should think about partnerships the way we did. Ask yourself, does this person make me more rational or less? Do they bring stability or drama? Do they amplify my strengths or magnify my weaknesses? The wrong partner can ruin decades of work. The right one can multiply it. In the end, what worked between Warren and me wasn't brilliance, it was compatibility. And what didn't work were the rare moments when we forgot our own rules. So don't mythologize us. We weren't gods. We were just two stubborn men who shared a brain when it came to money. And that was enough. Here's something most people don't want to hear. Getting rich after 50 is less about making brilliant moves and more about avoiding fatal ones. At that age, survival is the strategy. You can still build wealth after 50. I've seen plenty do it. But they didn't do it by chasing hot tips or trading like 20-year-olds. They did it by being boring, steady, and relentlessly rational. The surprising truth is this. You don't need to double your money overnight. You just need to not blow yourself up. Let me give you an example. I knew a doctor, good income, sensible spender. At 55, he started funneling his savings into a basket of high-quality dividend stocks. He ignored the noise, reinvested dividends, lived below his means. By 70, he wasn't spectacularly rich, but he was financially free. No debt, plenty of income, comfortable, secure. Now compare that to another man I knew, a sharp entrepreneur who thought he was behind. At 52, he dumped his savings into speculative real estate deals, leveraged to the hilt. When the market turned, he was bankrupt by 57. The difference wasn't brains, it was discipline. Here's the paradox. At 50, you don't need brilliance to win. You just need to stop doing stupid things. And believe me, the world offers you an endless buffet of stupid things. Crypto scams, day trading fads, exotic real estate schemes. The list never ends. If you want to get rich or stay rich after 50, here are the rules. Keep it simple. Own businesses or assets you actually understand. If you can't explain it to your spouse in 1 minute, you probably shouldn't own it. Preserve capital. Every dollar you lose at 60 is far more expensive than every dollar you lose at 30. You don't have decades to recover. Avoid envy. Don't look at the guy who doubled his money in some risky bet. Most of the time he won't keep it. Your job is not to keep up, it's to stay standing. Play defense. A steady 7% compounded over 15 years is a miracle at 50. It doubles and then doubles again. By the time you're retired, you'll look rich to anyone who spent those same years chasing fads. Most people over 50 forget this. You don't have to be spectacular. You just have to be solvent. The world has a way of rewarding the ones who endure. The truth is, I didn't plan to become a billionaire. I just avoided stupidity for long enough that compounding did the heavy lifting. I overshot. That's the game. So, if you're over 50 and worried it's too late, stop panicking. You don't need to reinvent yourself. You don't need the next big thing. You need patience, simplicity, and durability. It's not glamorous advice, but it's the only advice that works. If you want one blunt truth to end on, here it is. If you're not spending less than you earn, nobody can help you. Not me, not Warren, not the smartest financial advisor on the planet. The laws of arithmetic don't care about your feelings. They don't care about your lifestyle. They don't care about your excuses. If more money flows out than flows in, the end result is guaranteed. You go broke. I've watched people with six-figure incomes live like paupers in old age because they couldn't resist spending everything they made. And I've watched modest earners die comfortable because they lived simply and invested consistently. It's not intelligence, it's not opportunity, it's behavior. Overspending is the fastest way to ruin any investment plan. Doesn't matter if you're 25 or 65, if you keep digging the hole deeper, compounding works against you, not for you. People ask me all the time, Charlie, what's the best investment at my age? My answer is usually, stop buying crap you don't need. That advice alone would solve half the financial misery in the world. At over 50, the consequences are sharper. You don't get to make infinite mistakes. You don't get to start over every decade. Your choices either set you up for a dignified retirement or they set you up to depend on others. The goal at this stage isn't glamour. It isn't chasing the biggest return. It's dignity. It's independence. It's knowing you won't have to beg your kids for money or work until you drop dead. And that doesn't come from clever trades. It comes from restraint. If you cut out debt, avoid drama, ignore dumb people, and live below your means, you've already beaten 90% of humanity at the money game. Do that for long enough, and compounding will handle the rest. But if you overspend, forget it. Nobody can save you, not even the stock market gods. So here's my final question. When you're 70, do you want to be envying your neighbor's toys or enjoying your own freedom? The choice is obvious. The execution is rare. Remember, the world doesn't reward brilliance nearly as much as it rewards avoiding stupidity. And nothing is more stupid than spending yourself into misery. That's all there is to it.